So let's go over some numbers to try to show you why sequence of return risk matters and why Dave Ramsey's 8% safe withdrawal rate is not grounded in reality. So portfolio charts here put together one of the best responses that I have seen to Dave Ramsey's 8% withdrawal rate fiasco. If you haven't seen it, I'd encourage you to go check it out. It's very digestible, very understandable for most people. And I think it very clearly shows why an 8% withdrawal rate runs a significant risk of depletion before the end of your retirement. So the assumptions they make going into this is they're trying to mimic Dave's S&P 500 claims. So basically the assumptions they're running with is a large cap blend portfolio to try to mimic Dave's 11.8% average return over time. And what they're doing is they're running simulations based off past performance of from 1970 until now, when did they run out of money or did they run out of money by the end of their retirement? And the conclusion they come to is 2 out of 5 retirees would have run out of money if they're following Dave Ramsey's advice of an $80,000 or an 8% withdrawal rate on $1 million portfolio. Now, I don't know about you, but to me, a 2 out of 5 or a 40% likelihood of running out of money based off past performance is a pretty big risk to be taking when you are going to withdraw money from your portfolio. If that's the only thing that you have to live off in retirement is your 401k, your IRA, your investment savings portfolio, that's a pretty high risk. Now they also run it at the 4% withdrawal rate, and the likelihood of success is much, much better. And you can kind of do your own mental math to try to think of what's the likelihood between 4 and 8%? What are the likelihoods of me running out of money in retirement? But I think one of the most interesting things that Portfolio Charts is showing here in their graph is look at the huge disparity between the starting points in somebody's retirement. That disparity is the fundamental principle of sequence of return risk, and it's something you have zero control over. Somebody retiring in the 1970s, the 1980s, the 1990s, even having the exact same portfolio composition of a large cap blend, is going to have vastly different outcomes. And in retrospect, it might be clear. But the thing to think about is at the time and looking into the future, they had no idea what the future was going to hold. So to be prudent and smart, you need to be thinking about all possible scenarios you could run into in your retirement and plan around your retirement spending with those in mind. We have no idea what the stock market, the bond market, the asset markets, the economy, we have no idea what any of that is going to do in the long run in the future. And that's why having a prudent withdrawal rate in retirement is so imperative. You need to plan for the worst case scenarios, not just things going well for you. So I hope this better illustrates why Dave Ramsey's 8% withdrawal rate has a lot of risk attached to it.